Now, before I show you this, just you have to keep in mind, I'm going to ask for just 0.01% of your brain power to go what I'm going to show you. 0.01, not even a full 1%. This is how much I want you to give me in terms of your brain power. That's it. But it's more than zero, and you should be aware of it. Remember I showed you the hourly divergence. This is and I called it a microcosm of the bigger picture that I'm about to show you here. That's on an hourly chart. What happens when it is on a monthly chart? See it? No, I'm not saying I told you so. I'm really not. There's no way I can tell you I told you so because I don't have any shorts. I'm positioned very small, so today is certainly annoying. But this I wouldn't be doing my job if I didn't show you this, right? Certainly. Oh man, Nasdaq just cracked, or at least the things just cracked to a new low there. And the problem is, we'll kind of round back to that. There's nothing underneath. There's a level on the Qs. I think it's 75.66. I don't remember exactly. We'll pull it up, but there's nothing below there. So this thing could get really nasty. On the NQ, it is in front of me. The level is 420, 15,420. If it gets below there, again, you just start moving 100-point increments to the downside. So sorry about getting distracted there. Let's kind of put the points together here so it makes sense. Divergence, price goes up, indicator down. You see the end result, right? So then that's an hourly chart, which plays out relatively quickly. Look at that. This is a monthly chart, and it's on everything, literally everything. This is the SPX. Just to prove my point. Here's the QQQ coming up. Ideally, you do want to see it bounce here. There's absolutely no signs of it, but that really nasty little flush here that just happened in the FANG stocks that took him down 3% as a basket, you'd want to see that be it. You kind of want, it's like a drunk that that throws up. Like they're wandering around your house, they're knocking down your plants, they're knocking down your lights, they're looking real sloppy. And then finally you shove them outside and they puke up on the concrete. But there's no sign of it, not yet at least. So here's the NQ, or the QQQ, which is everyone's darling. Price way up. This is the biggest difference I've ever seen in my life. Indicator down. All right, so is that enough? Not yet, but here's where it gets fun. Or maybe not fun. Because I just showed you a negative divergence on every index and basically every stock that matters, at least, on a monthly chart. So think about how long that will take to play out once it triggers. So then let's look here. This is the ZN. This is the 10-year futures. And I want you to note, one, how well the indicator works. But then two, what do you see? Do you happen to see it? I'm going to give you the trigger. I'm going to give you everything today. I'm just going to lay it all out there for you. I even have a trigger for you. So I'll even give you the timing on it. Doesn't mean I'm right, but I'd be willing to bet that I am. I'll give you everything. So here's ZN. There's a low. There's a significantly lower low. See how prices, you actually have a positive divergence on this, right? So I get it. ZN looks like absolute garbage. I totally get it. But then look at this. Here's a low. Here's a lower low. Positive divergence. From there, bang. So then you have to ask yourself, okay, Sam is showing me a negative monthly divergence on the indexes, all of them. And he's showing me a positive divergence on ZN with an example of how it played out before. So how do you tie these two things together? What would possibly make bonds do this, similar to this, off of this positive divergence that's in play? Only one thing, and it brings us back to this. Oops. credit event. What does that mean? It means there's a Lehman somewhere. That's what that means. Okay, so now that you're properly lubricated, let me show you the trigger, because I can even give I'll even give you the timing signal. But you don't want to wait till the very end, right? It's like you don't want to. I see this mistake a lot in this room and in myself, frankly. But I see this mistake continuously, and I wish I didn't. And that is a lack of risk appreciation until the risk is right in your face. So in terms of the signal and in terms of the timing for the event, we go back to the yield curve. If this chart, I've covered this extensively, so I won't cover it again as extensively, but basically the trigger for the credit event that I'm talking about is this. In the exact same way that 2007, in the exact same way that 2001, in the exact same way that 1990, in the exact same way that COVID. Now, what's the trigger? Getting above this high. So negative 0.2. The secondary trigger, above 0. And then the last warning sign that you will have before the credit event, positive 0.5. So if you just want to write that down, positive 0.5 is the trigger for it. It won't be any different this time, guys. If anything, it's actually going to be whatever this is that the market is signaling is going to be even, it's going to make this look like child's play. At least that's what the charts say. So that is the song and dance on that. And if you're going to counter what I just brought to you, please do play devil's advocate against what I said. You know, no one has a monopoly on truth or clarity, but if you're going to play devil's advocate, it has to be done through a chart. It can't be done through some kind of narrative or anything like that. It has to be done through charts.
Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.